Hey, superstars. Thanks for joining us today. I'm your host, Aaron Zakowski, and today I'm chatting with Thomas Smale. Thomas is the CEO and founder of HowFE International, an M&A firm that advises SaaS, e-commerce, and content businesses. Thomas has consulted thousands of entrepreneurs on exit strategy, growth, and business development. Hey, Thomas, how you doing today?
Hey Aaron, I'm good. Thanks for having me on.
Fantastic. Good to have you on the show. So just to kick it off, why don't you tell us a little bit about yourself and about your company?
Yeah, sure. So my name is Thomas Smale. I'm the founder, CEO of HowFE International. We currently have around 90 team members across the globe. Our
Yeah.
head office is in New York. Our second biggest office is in London. I'm personally based in San Francisco, and then we have an office in Miami and various other places around the world, particularly in like the Western US and Europe. So we have a team everywhere. We work on lots of different things, but the main business is mergers and acquisitions. So in simple terms, we work with people who own businesses anywhere from $100,000 valuation to $150 million valuation is the biggest we're working on at the moment.
Uh-huh.
We ultimately help them sell their business. So we work with them through the valuation process, preparing it for sale, negotiating a deal, and then working with buyers in our existing network. We've been in business 11 years now, so we have a lot of buyers on the network. We run various outreach programs, events, whatever it might be, to get more buyers into a network who are interested in buying a business.
Yeah.
But ultimately, our client, the majority of the time, is the seller. So we're representing the business owner. So technically, the buyer is not our client, even though it's obviously in our best interest to build that relationship.
Okay, fantastic. So as we discussed a little bit before, the way we're going to take this interview today, I'm kind of going to talk personally. I've been involved in a lot of SaaS businesses, doing paid advertising. We've helped a lot of companies grow. And I've actually been thinking about, would it be a good idea for me to purchase a business that I can, grow on my own? So I'm going to take this opportunity to ask you questions kind of from a potential buyer's point of view and a first-time buyer's point of view about the, best practices, pitfalls to avoid, et cetera, of buying a business. So starting off, broad question, what should entrepreneurs be looking for when considering buying a business for the first time? What should their considerations be?
Yeah, so I think it's a good question because I think a lot of people get attracted by kind of trends, or they go on like Twitter or Facebook and they see everyone talking about something. They're like, oh, I should definitely buy that. It sounds really cool.
Uh-huh.
But ultimately, I think the very first thing you need to establish is if you're working by yourself or if you have a team, like what is your skill set? What are you good at?
Yeah.
Where can you add value? There's no point buying a bit. Like a lot of people would be like, oh, you should buy a SaaS business. But if you don't know anything about tech, you can't write code. There are exceptions, but you probably shouldn't buy a SaaS business. Maybe you should buy an e-commerce business. Maybe you should buy a blog. Maybe you should not buy a tech business at all. Maybe you should buy something else. So establish your skill set and be honest.
Yep.
Because everyone's doing something doesn't necessarily mean it's the right thing to do, particularly in investing. Figure out what your goals are. I think that's very important. Again, lots of people get distracted by other people's goals. Some people's goal might be to buy a small business, make $5,000 a month, go live on an island, and that's more than enough to sustain them as a single person.
Yep.
Other people have completely different goals. We might live in a different part of the world, like where I am in San Francisco. $5,000 a month doesn't go very far. I know that's extremely privileged way of thinking about things, but particularly in the world of like online and tech, you get perspectives of people all over the world. So to one person, $5,000 a month is a lot of money.
Yeah.
To someone else, it doesn't even pay their rent.
Yeah.
So
I get it. I'm in Los Angeles.
figure out what your goals are and figure out what's important to you. And there's not a right or wrong answer. There's no way I can tell you, my team can tell you, a wealth advisor can tell you, an accountant can tell you. You have to figure out what's right for you. And part of that as well is also, what are you willing to do? Are you willing to work 80 hours a week to build a business? Or do you just want something that's going to be, yes, passive? So it's going to take 1 hour a week to manage.
Yeah.
So you have options for both, but you have to be super honest with yourself, because some businesses you look at acquiring are going to be a full-time job. Others are going to be more part-time. And not that this was your question, but sellers will generally underestimate how much time they spend on a business. And as an entrepreneur yourself, you're aware that generally running a business is a full-time thing. There are very few people who genuinely spend an hour a week on their business, particularly if that's their only thing.
Right, makes sense. So when I've gone onto marketplaces and websites where businesses are being sold, I tend to be a little bit nervous, maybe a little bit skeptical, and I look at these businesses and I wonder, what's wrong with this? Why is somebody trying to sell? But I assume that's probably not the best perspective. There's probably a lot of reasons why people sell that aren't necessarily because they see that their business is fading or kind of on a downtrend or something like that. So if you could share with us, why are many, some of the reasons maybe why people might be selling that aren't probably necessarily bad from the point of view of the buyer?
Yeah, I mean, so firstly, it's a perfectly reasonable concern. Like at FE, one of our biggest jobs is establishing the legitimacy of a business up front to make sure the seller is serious about selling, the reasons they provide are at least believable or provable. There's not a fundamental problem with the business that they've not disclosed. And while ultimately as a buyer, it's your responsibility to do due diligence, one of our big value adds is we do that. So my answer will be slightly different if you're looking on a marketplace. A lot of marketplaces these days are quite good at verifying what they would describe as due diligence, but isn't real due diligence. Like, does this person own the domain? Is the revenue $10,000 a month per stripe, which they're disclosing? Very, very few people lie about owning the domain or their revenue because it's way too easy to verify. People lie about things like the amount of time they spend, those kind of things. That's much more difficult to figure out. And I guess that's why most of our process is not really automated. There's lots of people in the process because you can trick a system, but it's harder to trick people after over 1,000 deals we've completed. The genuine reasons why we see people sell. So again, my caveat here is this is if you're buying a business through us that we're representing. Probably the most common reason is they have a bigger project or another business they're working on that maybe they prefer, maybe they think it has more potential, just a general interest thing. We're very rarely working with people who are retiring. Most people we work with in their like 20s, 30s, 40s, even if they sell their business for 50 million, they're still not retiring. They're going to go do something else. So generally a bigger project. Sometimes it's just lost passion. And I think this is a hard one for people who've never run a business to understand, because it's a really common question. Like for people who've never been an entrepreneur, never run a business before, they were like, oh, why would you ever sell a business? Why would you ever get bored of a business that's making you money? But when you actually have it, you realize that a business is a big commitment. So you can lose passion, lose interest. And to my previous point about what's a good business to buy, something you're interested in. Conversely, a good business to sell is one that you're no longer interested in. And I say your interest and passion change over time. It's not like what I personally liked 10 years ago, I mostly still like the same things now, but a lot of things are completely different. And that's the same with most people, like things change. Another really common one, particularly at the lower end of the market, so say generally valuation, let's say below $2 million, the founder or founders have grown the business as much as they can with their skill set or maybe their goals as well. So a very common reason is they realize to scale the business further, they need to hire and manage a team. A lot of people are not willing to hire and manage a team. And to my previous point, that's not wrong or right. It's not objectively either direction. It's ultimately if you don't want to manage people. Managing people is a very big commitment. Hiring people, and I think a lot of people don't realize that until they've hired their first full-time employee. They have a mortgage, they have wife or husband and kids. They want a 401k. They want various other things. If they're in the US, at least they want a 401k. It's a very big commitment to just hire one person. So a lot of people don't want to do that, and they realize that up front, so they'll look to sell. From a financial perspective, like the other reason is capital gains. If you're selling a business, generally paying capital gains, it is a lower rate than income. So sometimes it's just financial, like, hey, I can sell my business for 4 or 5 times, pay a lower tax rate, take a year off. It does happen, like kind of a mini retirement, and then they get back to with something new. So I'd say they're the most common reasons.
Yeah.
On marketplaces, you have to be a lot more careful because people have lots of illegitimate reasons, or legitimate to them, but they're not going to tell you. Like they know there is a regulatory change in the industry coming up in 6 months' time that you're probably not going to find Googling, but they may well find because they're a member of a kind of industry association, or they went to a conference and someone told them about it. So things like that. That's a little bit more.
Yeah. A tech that's becoming outdated, or a bigger competitor that's coming to eat their lunch, or something along those lines.
Exactly. There's all sorts of things, and it's generally very difficult to get a seller to disclose that to you. So I'd say you are entirely correct being skeptical of businesses being sold, particularly on self-serve marketplaces, because generally people are not lying about the things you think they would lie about. Very few people lie about revenue. It's too easy to verify.
Right. So let's leave marketplaces aside for a moment and think about, in the deals that you do with your network. Are there mechanisms that could be built into a contract that can reduce the risk on the part of the buyer? So for example, there's a trial period where I guess the deal could be reversed, or decide rather than selling the whole company, keep the seller involved in the company so that they still have an interest in it that makes them want to have it succeed, or anything along those lines.
Yeah, so trial period, definitely not. I'd say in general, if you're buying a business, you've got to be comfortable with buying the business.
Okay.
So the thing we do up front is have a very clear outline due diligence period. So before we would accept any offer from you as a buyer, we would get you to outline what your requirements are and what you're worried about. So like, what are your main concerns? If you send us a list of 500 things you're worried about, probably not going to be a good fit. If you've narrowed it down to like 10 things, like, I'm concerned about the future of this industry because company X just announced this. How does it affect the business? That's quite valid. If you're sending across the list, like, how do I know you've not photoshopped this? Like super paranoid questions.
Yeah.
Generally gonna be a lot harder to get over the line. So firstly, at some stage as a buyer, you are taking on the risk of owning the business. There are ways as a buyer, I would suggest you can structure a deal to make sure that the seller is incentivized to help you. So firstly, really common is what we'd call a holdback, which is effectively a percentage of the total deal price, usually around 10%. So let's say it's $1 million deal, it might be $100,000. That's put aside for 3 or 6 or 12 months tied to a contingency that the seller has to fulfill, and a very objective contingency. So it's usually training. Like, hey, I'm Aaron, I'm buying this business. You're clearly the expert at this industry. I know about SEO and marketing. I run a podcast, I know what I'm doing. All these things, what I don't know about the industry itself, I need you to help me 10 hours a month for 12 months. At the end of the 12-month period, assuming we've done that, you release $100,000. So you make it a large enough amount that it incentivizes them to stay interested. But it can't be so large that there's no point in them selling the business, because if you change it and you're like, on that $1 million deal, I'll give you $100,000 up front and $900,000 in a year once you trained me, no legitimate seller is going to take that deal. So if someone does offer you extremely favorable terms as a buyer, that's where I'd start to get a little bit skeptical. The market is very strong as a seller at the moment. So if people are offering terms which seem too good to be true, then they probably are. I know it's a bit cliche, but so the training holdback is a good one. We see that on almost all deals which involve some level of seller involvement. From time to time, again, depending on the business, some form of performance-based structure tied to revenue, net income, gross profit. The metrics will really vary depending on the type of business. Always possible, assuming there is a good reason why an earnout is necessary, because there are plenty of buyers out there who are willing to buy a business without one. So a common one might be, hey, Aaron, you own the business. There's 10 clients who make up, say, 50% of the revenue, and they're all clients you onboarded, sold yourself, you've met them in person, you have the relationship, and they're paying $50,000 a year contracts. So you'll tie in some form of performance-based contingency to make sure they renew. And the purpose of that is not so as the seller, you have to do all the work, but the purpose is from the buyer perspective, the seller is incentivized to not lie about the relationship. Because often people, like the clients of the business, will be like their brother or their uncle or their girlfriend's dad or sister-in-law. There'll be relationships in there that will not necessarily be disclosed and are almost impossible to figure out. Hence why earnouts are, I feel like they're good to ask for, tied to very specific contracts and outcomes, because then if they don't agree to it, you might then start digging a bit further and be like, well,
yeah, that's really
why would they not agree if they have a great relationship with these 10 clients and they've told you up front they're sure they're going to renew? Why would they not be willing to tie, again, caveat, a small portion of the deal to that renewal? Like, it's in their best interest and yours. So again, it does sometimes depend on the deal itself, but from a buyer perspective, I'd say training hold back, you should always at least ask for it.
Yep.
Always get it, but you should always ask. And some form of earnout if you believe that the seller has a really good relationship with some clients, or some reason why their lack of involvement in the business would potentially cause that client or clients to disappear or not renew or whatever it might be.
Yeah, that makes a lot of sense. I hadn't thought about that. Moving on to financing a little bit, what are some of the creative ways that someone could use financing to purchase a business without necessarily having all the capital up front? So let's say I want to buy a business for $1 million. I don't have $1 million in my bank account, but I believe this business. Are there ways to make things like that happen?
So it's definitely difficult, particularly in the current. If you went and, so this is where, say, let's call it the tech industry is a little bit different from the offline world. If you go to a traditional business broker and you say, hey, I want to buy a restaurant, then 99% of those deals will be done with some form of debt, because banks are used to lending against real estate effectively. And the inventory is like, hey, we have a kitchen full of materials. That's kind of easy for a bank to value. It's like fixtures and fittings are worth this, the lease is worth X, easy to lend against. Online businesses is definitely slower to catch up. So if you're in the US and you're either a US citizen or you have a green card, you can get an SBA loan, which is government-backed loan. They were also behind like the PPP program, which most US business owners took advantage of. Various things like that. But you can use the SBA program to buy a business. I said that's definitely the most common form of financing we see that buyers get if they only have a small percentage of the cash to put down. Most buyers, as they get larger, they're probably not using their own money. If they're private equity firms, they have other people's cash. But I guess they've already answered that question. They've already figured out how to raise capital. So like, well, we raised $50 million from investors. So there's always a possibility you can go raise the money yourself privately from investors, debt, or whatever, a combination of the two. I would say there are definitely sites out there and kind of companies that claim they'll help you fund a online business. I've seen lots of them, I've heard lots of claims. And while I wouldn't say it's impossible, I'd say the majority of them have said they will provide revenue-based financing to buy a business or whatever, generally are not going to offer you terms which are good enough to go ahead and actually buy a business. Particularly, I still be completely honest, as a buyer, it's very competitive. There are plenty of buyers out there who have either just physically have the cash already, if you're competing against buyers more. They have already raised the money or got pre-commitments from investors or whatever it might be. Maybe they have a much bigger business and then you can borrow money. If I have $50 million sat with JP Morgan in bonds and net equities, and I want to borrow $5 million to go buy business, I can call my banker and in a couple of days get that cash unlocked based on the equity. So I guess the playing field is not necessarily fair if you are in that position where you're like, hey, I only have 100K. So my advice usually to people like that is start with something small, build it up and try to find a way to get the capital in advance. So I definitely wouldn't want to put people off trying to get creative, but just in my experience and from what we've seen, it is uncommon, despite all the promises of the companies, and often the terms they'll offer will be, I would say, not good enough to justify doing it. And the other problem, if you do need some form of outside financing or contingency on your offer, it's very similar to real estate, but probably worse, what you're going to have to pay is going to be substantially higher than the cash buyer. So the cash buyer might have to offer $1 million. If you're like, well, I need 90 days for SBA, maybe you have to offer $1.2 million. So yes, on paper, you've borrowed money at 3% if you get through the SBA program, but you've also paid much more money for the business in the first place. So it's not quite as good as it sounds. So it's definitely not me trying to put you off, but I'd say it is challenging. And as a non-cash buyer, you're definitely behind buyers who have cash. And particularly in the US, there's a lot of capital out there at the moment. And I don't see that slowing down anytime soon, to be completely honest.
Right. Yeah. It sounds like, if you're going to get your financing, but don't make it part of the deal. Just go get your loans in advance, go get your investors lined up in advance and come with the cash in your hand already.
Exactly. And I'll put you at the front of the queue and get a better deal, better terms.
Yeah.
To your earlier points, like, hey, I want a training hold back. I want an earn out tied to these important customers renewing. Much more likely if you have cash on hand. If you're like, hey, I need 90 days because I haven't actually got any money. So I'm going to go ask a bank for some money, whether it's SBA or whatever. Plus, I want you to train me for a year because I'm a bit worried that you're ripping me off. Plus, I need you to do this, this, and this. Like, while your concerns might be completely valid, you're probably not going to be at the front of the line to do a deal.
Yeah, that makes sense. Yeah, that's helpful. We touched on them a little bit, some of the marketplaces out there. I know obviously, it's not the way that you work. You've got your network and you've got your deals, but I'd imagine there's some marketplaces out there that are good places for a smaller investor to get involved in buying a business. I'm not going to ask you to tell me which ones you don't like because we don't want to badmouth anybody, but are there any out there that you're aware of that you think are trustworthy, good marketplaces for people to be looking for businesses?
Well, I think there's marketplaces out there you can go to, which I think do a really good job of verifying the basics like revenue. So I think you've got places like Flipper, MicroAcquire in the software space, which will verify the revenue, like I said, but it's very much a self-serve process. I would generally say if you want to buy a business and you know what your skills are and you know what your goals are, probably the best way of doing it is just reaching out yourself. So find 20 of those companies and email them being like, hey, I'm looking to buy a business. Here's my background. Are you interested in a conversation?
It's like even when they're not actually being publicly marketed to be sold anyways, just reach out straight away.
Just reach out to people. When I first started in the industry 10, 11 years ago, Flipper, MicroAcquire, all those kind of places didn't exist. So you had to go look yourself. There wasn't really any other way of doing it. So definitely one way to do the deal. I'd say one challenge with the marketplaces specifically is a lot of sellers will just list on there because they can. So there'll be a lot of time wasters, and this applies as a seller as well. That for every kind of 100 businesses listed on there, 90 of the sellers are probably just not particularly interested in selling. They're just fishing, seeing what kind of number they can get, using it as leverage for something else. So it's definitely worth having a look, but I'd say in general, if there is a really good business, similar to if you're buying through us, it's probably going to be very competitive as well. And if someone's willing to offer you, like I said, too good to be true terms, there's almost no scenario, regardless of what people think, where you can go onto one of those marketplaces, and there's tons of them out there, where you are the only person who's discovered a really good SaaS business that someone is selling for 2 times annual net income. Yeah. It just doesn't happen.
It's been sitting there for more than a week or two. It's probably not a good deal. That's what you're saying.
It's not necessarily that it's been sitting there for too long. It's just if the terms just seem like way better than market, you are probably not the person who's discovered it on a marketplace where thousands of people visit every day. Yeah. Hence why emailing people direct can be good, because we have quite a lot of clients actually who their entire business or a substantial part of their business is buying businesses privately, working on them for a bit, whether that's 3 months, 3 years, 10 years, and then they come sell it through us. So kind of like an arbitrage opportunity. That's more prevalent, I'd say, if you buy privately versus on a marketplace, because on a marketplace, challenge of that is lots of people look at the business, lots of unqualified people, and the big challenge as a buyer on marketplaces, regardless of how private the information is, you can always it's relatively easy to get the name of the business or whatever it might be.
Mm-hmm.
There's a really big industry out there for people who are starting out, and they figure out you can get inspiration by visiting marketplaces and seeing what other people are doing. And often small businesses have relatively low barriers to entry. So I don't know, let's say you have a time tracking app for nurses, and it's listed on Flipper, for example, and 50 people look at it, it makes $2,000 a month. In 12 months' time, there's probably another 10 time tracking for nurses apps with very similar names, very similar looking businesses, because there is a big market of people out there who go there for ideas. And the marketplaces, I guess, their incentive is to get the buzz and get like PR, get people talking about it.
Yeah.
They don't necessarily, with some exceptions, they don't necessarily care who it is. They just want the buzz. So if 10 people are going there to kind of, because it's great for ideas, and they'll tweet about it, share on Facebook, LinkedIn, whatever it might be, tell their buddies, that's good for buzz. So you do have to be a little bit careful as a buyer, because you can buy a business and then suddenly be swamped with competition. Yeah. Hence why buying private is good, because the vast majority of actual serious buyers are not cold emailing or warm emailing or whatever it might be, sites they want. They're just browsing marketplaces and messaging 20 people being like, tell me more about your business.
It's interesting. It sounds like, the parallels that you've kind of touched on, just to real estate are quite strong. I've got a little bit of experience, having done a couple of real estate deals in my life. The idea about coming, with an all cash offer puts you at an advantage. The fact that, once something's listed on the MLS in the real estate world, the whole world knows about it. You've got your bidding wars, all the buyers, both serious and not serious, are already competing on it. But if you could find those quiet deals that haven't been listed yet, those are often where some of the best possibilities and opportunities come about. That sounds very similar in this world. Exactly.
I'd say like a lot of the buyers who are either in the industry or transition to the industry do have a real estate background. So there's lots of similarities from a deal making perspective. Probably the main difference at the moment in the industry is lack of transparency over comps. Like you don't, the vast majority of sales, the actual final sales price is not disclosed. So there's often a lot of like misinformation there. Whereas if you sell a house, at least in the US, public information, you can find out what a house sold for. So being able to value a house is relatively, like when I bought a house recently, never bought a house before, and I was just looking at all the comps, made a spreadsheet, what do they sell for per square foot? And I'm like, well, my offer is this because that's what the house next door sold for per square foot.
Right.
That was my approach. But the business is much more difficult, because you can be like, well, this one sold for 6 times, but you actually don't know, because it was listed for 6 times. Doesn't mean it sold for 6 times. It could have sold for more, could have sold for less. So that's probably the main difference between the two. It's probably just because I guess the world of buying tech businesses is, well, thousands of years behind real estate, but I guess hundreds of years behind in the developed world, at least.
That makes sense. What should I have asked you about this process that I haven't yet? What else should people know in terms of, even from the seller side, buying and selling and doing these types of deals?
I think firstly, it's been an interesting conversation. I think the way you think about it is exactly how you should be thinking about it. I'd say in general, it doesn't hurt to browse and have conversations, as long as you're honest with, if you're a buyer and you're approaching a seller, or you're approaching a broker or an M&A firm like us, or even on a marketplace, there's no harm in like being quite honest. Like if you come to us as a buyer and you say, hey, look, we've got $100,000, $1 million, what can I do? Like, we'll happily speak to you years in advance. I think our data at least shows that the average buyer that joins our network doesn't buy a business for 2 years.
Interesting.
In our network, they look at lots of deals. We won't necessarily let you ask lots of questions. We're not going to let you get on 10 calls with sellers to have hypothetical conversations about whether or not you like their business if you're not ready to go. But we'll definitely let you kind of browse to a point. You can do the same with marketplaces. You can do the same cold emailing. So I say, don't be afraid to, if you do not know the answer of what are your skills, what you're interested in, what are your goals, have a little bit of a look first. Because I say the vast majority of people in that two-year period change what they're looking for, or narrow it down a little bit more, or maybe they broaden it. Because a lot of people come to us and like, okay, I've got $2.5 million. I want to pay 3 times multiple for an e-commerce business that sells green plastic pens, and that's what I need. And yes, it's not impossible. Again, I'm not trying to talk in absolutes, but it's highly unlikely a business like that is going to come along. As much as I like my company and I think we're good at what we do, probably not going to find you a business that sells green plastic pens, nor are we going to look for you, and nor are, except the marketplaces or whatever are out there. So a lot of people then broaden what they're looking for, and they're like, maybe I just want an e-commerce business. So that's where your goal, establishing your own goals, is important, because then you can either narrow them or broaden them in line with what's out there. I'm gonna say the most successful buyers that we've seen have broadened what they're looking for, at least initially, and then maybe they narrow down over time. But if you start too specific, we could have we can jump on a podcast in 5 years' time and still have exactly the same conversation. We're like, oh, Thomas, I'm still like thinking about buying a business. I've been like looking, but haven't managed to buy anything because nothing perfect's come along. Like that's always going to be the case if you're too specific. So have a look, think about it in advance. Like it doesn't usually cost anything to have a conversation with someone, or at least like read and do a little bit of research in advance. But ultimately, if you're going to buy a business, like a lot of it's just like psychological. You have to actually be ready to do it. Like I said, there's no trial period. You can go to a marketplace, you can buy directly, you can buy through us, and while we do our own due diligence process in advance, we can't guarantee you anything. Ultimately, you're the one that has to run the business. I will help you if you have questions, and so will my team afterwards. The seller will train you, but ultimately you're the one that has to run the business. So a lot of it is kind of personally and professionally being ready for the commitment of buying a business, and that often takes time. Hence why it's important to start looking, and then you can kind of figure out what you're willing to do. Not everyone wants to work 80 hours a week, and that's fine. Just don't buy a business that requires 80 hours a week of work. Find one that requires the same.
So let me change the direction a little bit. I'm going to give you an opportunity maybe to sell yourself a little bit here, but also I'm asking this question actually on behalf of a friend of mine who's in the process right now of selling. So we're going to switch from, we've been talking about buying business a little bit, but one question, we're going to focus on this shortly, but how does your company assist a seller? I've got a buddy right now who's trying to sell his company. It's his first time doing it. Never been through the process. He's trying to figure it out as he goes. How do you provide service for somebody like that?
Yeah, so this is the challenge with the industry today. 10 years ago is a little bit different. Part of the reason I started HowFE International was there wasn't really any way you could sell a business. And people would come to me and be like, hey, Tom, I was buying and selling businesses for myself, like very small ones, and then created the firm from demand that existed, but people didn't know existed at that time. Nowadays, there's loads of marketplaces you can go try for free, or you list for $10, whatever it might be. So you can kind of do it for free. A lot of people kind of forget about the opportunity cost. For us, so I'll go through our process, and I'll go through maybe the pros and cons. So we start with a free valuation. Yes, that's our lead gen. We will happily speak to anyone for free, put together a valuation, tell you what we think your business is worth, based on over 1,000 deals we've completed with a proprietary valuation model. We track data on literally everything. And to my point, we have the actual comps of what businesses have sold for. Like that's private information, but we have it. As a potential buyer, you do not have access to that information. As a potential seller, you do not. Many people have anecdotal data points. So they're like, oh, my friend sold for 10 times or 2 times or whatever. Very, I wouldn't say dangerous as such, but be very careful making decisions about selling your business based off 1 or 2 data points. Like, oh, TechCrunch said this person sold for 20 million. Like, you don't know the small print of that deal. It could have been $1 million in cash and then 19 million in performance, to our earlier conversation about what the deal looked like. Once we go through the valuation, if you then engage us, you only pay us if the business sells. So yes, we are not free, but the work is effectively free until the business sells. We then put together a sales package, what we call a prospectus, telling buyers about the business. Depending on the size complexity, it's usually a 20 to 40 page document about the business. For larger businesses, generally what I describe as large is over $10 million. We have an additional stage in there, which is what we'd call a teaser, which is a much shorter document, which generally large funds want to look at before they commit to reading a 40-page document. And then we, like I said, we go out to a network of investors we don't just blast an email list. So like we list it on our website, blast 100,000 people and be like, okay, let's wait for the bids to come in. It's not really how it works, unfortunately. So a very targeted approach of reaching out to buyers in our network that we know are interested in a business like yours. So to my point earlier about the guy looking for the $2.5 million green plastic pen business, if that happens to be the business we're selling, we'll reach out to that buyer and say, hey, look, we have the perfect business for you, or you told us you were looking for this. Would you perhaps be interested in buying a metal pen business? So we'll do that.
Yeah.
So then have a strategic approach where we reach out to either private equity firms or strategic buyers who could be a good fit. You never really know. It could be a buyer in our network who's actively looking to buy a business. Could be a strategic buyer who has a business similar or tangential or some form of similarities. Maybe they're the best buyer, or maybe a private equity firm. They have raised money to buy businesses like yours, effectively. We'll then help you navigate that process. So we handle all conversations on your behalf. I guess part of the value from a financial perspective is we're having those conversations. We're disqualifying buyers who are not serious. So Aaron, if you call up and say, hey, I want to buy this $1 million business, I have $100,000, I'll say, sorry, we can't help you. Here are some like suggestions of where you might be able to go raise the capital, and then come back to us. So we would always, as a buyer, we'd always have a respectful conversation with you, but we're not going to waste the seller's time if you don't have the capital. So it's where not we struggle from a marketing perspective, but we're not that popular with buyers because our job is to kind of, buyers like and respect our process, but often a lot of people don't like it because they're like, oh, I just want to chat to the seller. It's like, well, we're paid to.
You work for the seller.
Barrier. Exactly, we work for the seller. Like they're the ones paying us. They are our client. We don't want you to be ripped off. As a buyer, the best thing for us is if you buy a business, do really well, and come back and then buy 10 more businesses or raise 10 times more money. But the seller is our client. They're the ones we're working for. If you don't like it as a buyer, that's often a sign we're doing our job well. If you're super happy and every buyer is like, oh, wow, this business is amazing, such a good deal, valuation is really fair, then we've screwed up. And then we help negotiate through the process. And that's kind of the unspoken part of M&A. What people don't realize is how many buyers are out there who look very legitimate, will make offers, but the deal will fall apart. I think it's something like 90% of private deals, and I think you could probably include marketplaces in there. Maybe their success rate is slightly higher, but it's a very high percentage of deals will fall through, often because buyers will kind of get quite easy to create a business with a fancy name. So it'd be like Thomas Capital, put up a website, put like a stock photo of we do actually have an office in downtown New York, but you do a stock photo of New York and be like, private equity firm, Thomas raised $50 million to buy businesses. So you can look quite legitimate quite easily. But then often what a lot of buyers will do, and they'll not tell sellers this if you're selling privately, is they'll make an offer in a business, 10 million, 20 million, 1 million, whatever it might be.
Yep.
What they don't tell you is they then have to go out and raise capital. So they'll say, okay, it's going to take us 90 days to close. They're not actually spending time doing due diligence on your deal. They're spending time trying to figure out how to get the money. So extreme rate of businesses falling through. So a lot of what we get paid for is like using our experience to vet buyers and make sure they actually have the capital. Finding someone interested in buying a business is easy.
Yeah. Finding
someone interested in buying a business and actually has the ability to buy your business is much harder. Well, there's a very small nuance that most people don't realize. Like, oh, I listed my business on the marketplace and I got 50 inquiries. Like, that's great. That doesn't necessarily mean anything. Like, anyone can do that. Same with a house. You can put a house on Zillow and get 50 inquiries. Difference with selling a house is, firstly, like I said, transparent comps, easy to finance. Sure. You put 5, 10, 3% down and get a mortgage, and almost anyone can do that. Buying a business, that's not how it works. You have to already have the cash in most cases. Mm-hmm. That's what we do throughout the process. So a lot of it's just kind of navigating the challenges in due diligence.
Yeah.
As a seller, if you've not been there before, generally speaking, the buyer you are selling to is more sophisticated in the acquisition process than you are. So there's a huge number of pitfalls. I mean, we could do 50 follow-up podcasts for an hour, and I would not be able to give you all of the pitfalls. There's a huge number of things that buyers will do, and they'll be like, "Oh, this is like a really standard term. You should definitely sign this."
Yeah.
As a seller, you don't really know. You're like, "Oh, that sounds reasonable. Like my friend said that sounds okay. They sold a business, blah, blah, blah." Lots of different things can go. So a lot of what you're paying for us is experience, kind of peace of mind, high success rate. We sell 96.1% of businesses we take on. Sorry, 94.1%. So a very high percentage of businesses we take on. Our valuations are very accurate upfront. A lot of people don't necessarily like our valuations because they're realistic. Because people are like, "Oh, well, I heard that I can get 50 times for my business because TechCrunch said that this similar business sold for $100 million and it was doing $2 million revenue."
Right.
Like I said, you don't really know the terms. We do know the terms, hence why we're very realistic.
Okay.
As our process, we'll navigate at high success rate. Yes, you can try selling your business yourself and you can get offers, whether or not they're good offers or the best you can get. I guess you don't really know because there's such a lack of transparency. That's kind of what we do and what you pay us for effectively. Like I said,
okay. That's helpful. Wow. I mean, I've learned a ton on this call. I'm sure the listeners have also, so appreciate all the experience that you've shared with us, experience coming from working with all these businesses. Real quickly, before I let you go, we generally do a lightning round at the end, a couple quick questions with quick answers, and then we'll wrap this up. So first question, what book would you recommend? Business book, fiction book, doesn't matter, that you think people would enjoy?
So a book I read a long time ago, and I always remind myself of this in my business. And I think, actually, talking about acquisition is quite important. It's called Tipping Point by Malcolm Gladwell. It's kind of all about, well, it's about lots of things, but that at some stage in your business or life, you reach a stage where you suddenly kind of get to the next level.
Right, 10,000 hours.
Exactly, but I think a lot of people get kind of impatient. But I don't know, in my business over the last 11 years, we've had times where, I remember we first got to our first $1 million revenue. This was 10 years ago now. And then we got like stuck for like 6 months. It was really hard. We were like, "Oh, wow, maybe we could never get beyond $1 million revenue." And then you start growing again. And then you get to like way past $10 million revenue now, but you get to kind of get to 10, you're like, "Oh, it's gonna be really hard. How do we ever get like above this?" So you have, I guess you can have multiple tipping points. Yeah. I like books that kind of put things in perspective. Sometimes you get stuck and you have to keep working to get to the next level. It can apply to acquisitions as well, because you can look at kind of 5 deals in a row and 5 sellers might not be serious. It can be very easy to give up.
All right. So next question is, who's a marketer or business leader that you're learning from these days?
Sorry, can you repeat the question? I didn't know
a marketer or business leader that you're learning from these days.
So in the SaaS space specifically, I'm not sure if you're familiar with Dan Martell, but
of course
we work with a lot of people who have worked with him as a coach. And I think if you're looking to sell a business or grow a business, I think some of the coaching he provides is really good for founders to help them make a lot of these decisions. So a lot of things I said that we can't tell you, I think he's really good at doing it in a very direct way. Like, he will get you through the psychological barriers of like what is and isn't possible. And also from a technical perspective, he's been there and done it before. So I'm generally like personally not usually a big fan of coaches. I think I'm kind of often be quite skeptical, but I say with Dan, like he's the real deal. He doesn't pay me to say this. He doesn't know I'm saying this. But he does a really good job. A lot of the people in his coaching network have come to us and
absolutely. I've actually worked with some of the clients we've worked with have been coached by him as well. So Dan is one of the best out there.
Lucky coincidence on the answer.
Yeah. Thomas, where can listeners go to learn more about you?
Yeah, so quite active on social media. You can usually find me on Twitter, Facebook, LinkedIn, whichever one you prefer. I'm active there. The team, so the HowFE International team, are active there. If you go on the HowFE International website, we have tons of free content. Like I said, 99.9% of what we do is free. You only pay us when we sell your business. So we have tons of content, whether you want to, well, if you're listening to this podcast, maybe this doesn't apply, lots of people just like reading content. So you can go to our blog. We have lots of ebooks you can download. We publish like white papers, industry reports on what's going on. So check out our blog. There's content for everyone, like beginners, more advanced. Lists of podcasts we've been on, like conversations like this are super interesting. I think personally, if I was a buyer, I would learn more from this than reading a couple of blog posts. So I think kind of look around, see podcasts I've been on and conversations we've had like this.
Okay, well, fantastic. Thomas, thank you so much for joining the show. I know I've gained a lot. I've learned a ton. I know the listeners have also. And thank you very much for joining us today.
Cool. Well, thanks so much.